Hey, good afternoon. We are going to break down all things job here this week on our market update. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday at 3 is to bring to you the market news and things that we're watching and hopefully weed out a lot of this noise, especially lately along the way. If you're in the Pacific Northwest area, I hope you're able to stay dry. It was wet last weekend. It's wet this weekend. Certainly doesn't feel like June. I was actually at a country concert last weekend at I believe they call it Lumen Field now, and it was pouring the entire time. It looks like this weekend we're in for the same treatment. So hopefully it'll stay dry and hopefully some more good weather's on the way. Anyways, this week is all about jobs. We're going to also touch on a question of the week about how to handle market downturns and hopefully shed some light in that arena as well. But to start with the job side of it, on Wednesday of last week, if you guys follow, I touched on this briefly last Thursday, but we had ADP employment numbers come out and they were just terrible Wednesday. It was about 128,000 jobs added for the month of May. But the key is to always kind of take this number with a grain of salt. And I mentioned this last week as well, but every month we get ADP employment and then non-farm payrolls comes out just a couple days later on Friday. The ADP employment sort of kind of can give us an idea of what we may be able to expect on Friday, but it's really not the most telling or accurate indicator of what's ahead. The real measuring stick is really non-farm payrolls. And that came out last Friday, where we saw 390,000 jobs added for the month of May. It was a great number versus expectations. The expectations, I think, were just shy of 330. But it was down from 436,000 the last month. So the question everybody is talking about is, was this jobs number like just right for the Fed? And I think it was, is my answer to that. I think the Fed will look at this number and feel much more confident in their path that they have set forward around continued rate hikes. So I think basically this jobs number all but solidified that plan even further. Now, the key, though, is that, it's kind of funny to me that we're talking about this and it's like all over the news because the Fed has been very clear that they're going to lay out what they're going to do and work as hard as they can not to surprise the markets. So, most likely we kind of knew this was the case already. I would say that this probably solidified those plans even further. But really, it was probably going to happen regardless. That said, we'll likely get the verdict next week, which I'll talk about here in a minute. So what does all this mean for the markets? If we go back to last Friday when we saw the non-farm payrolls come out, we actually saw markets drop quite a bit. And it's funny to say that, right? We get this good data point. But remember that with these data points right now, the focus is almost entirely on the Fed. And so a lot of times when we hear good data, what it means is that the Fed may act more quickly. And so it's almost like you've got to balance out both sides of the equation here when you look at a data point and not just assume something good is good, because good could mean future problems, if that makes sense. So anyways, we saw the markets drop a bit on Friday due to the concerns around higher rates still to come. But I want to point out again that really the Fed has been extremely clear that they plan to hike rates anyway. They plan to do 50 basis points. They've shared that time and time again. And they've said multiple times flat out that they do not want to surprise the market. So, does this jobs number lead to more likelihood of a 50 basis point hike? Sure, but, the odds were probably pretty dang high already anyway. Fast forward to today, Thursday, initial jobless claims came out at about 229,000. Which is quite a bit higher than expected. So hopefully this is just a blip in things, but we'll see obviously next week how this trend either does or does not continue. Coming up next week, we have a ton to cover because inflation data is coming out. So get ready. We'll spend a lot of time on inflation. We also have retail sales on Wednesday and on Wednesday as well, the Fed news conference. So we've got a ton of stuff for next Thursday lined up. The retail sales, we kind of brush over that from time to time, but this will be important to really see how strong the consumer is after some of this Target and retail challenges that we've been hearing about over the past few weeks or so. Again, the Costco's earnings, I think, nip that in the bud a little bit, but the retail sales number on Wednesday will shed some light in that as well. All right, with that, we will touch on our question of the week, which is how to handle downturns, right? Here we are, June 9th. The markets are down depending on which index you look at, but double digit down year to date. And so it's a great question. We talked last week, I believe it was, about tax loss harvesting. If you haven't, take a look at last week's session to get an idea of how to consider some tax loss harvesting strategies while the markets are down for your non-retirement accounts. But today, let's talk a little more broadly. So I think there's, let's call it 4 points to consider when looking at market downturn. The first, which is hard to do now, is to have these conversations prior to the downturn. Obviously, it's a little late for that, but I do want to point this out that this is extremely important, whether this is with your advisor, whether it's with your spouse, whatever the case might be. It is extremely important to think about this and really think about this before you head into these market cycles. This will happen again, I can promise you that. And so understanding how you actually feel when you see your portfolio drop is extremely important. We can all sit here, cool-headed and say we're risky and we have no problem. Then it happens, and sometimes we feel a little different. So have those conversations. I would suggest, whether it's an advisor or not, a third party may help you to facilitate some of that too. So have those conversations ahead of time. Second is to take emotions out of your investments, right? It's very hard to play defense when the markets are going up. And especially here we are in 2022, the last, 2-3 years. I mean, it's been very hard to want to play defense because wherever you put your money, it seemed everything went up. Here we are, and markets have shown that, cycles happen. And so however exciting things are going, like all the euphoria about this great market, going back to last year, it is extremely important to take emotions out of the equation and take chips off the table when most are, piling in, right? When most are feeling that euphoric feeling. So when you have those upturns, it is important not to throw the baby out with the bathwater here or over exaggerate the point, but it is important to start taking some chips off the table, whether that's rebalancing, whether it's simply pulling some cash as things really start to do well, whatever the case may be. Third is, assuming that we've been able to do that or have some reserves, is to look at these as potential buying opportunities. Now, I'm not saying that the market's going to rebound from here. I wish I had that answer. But, obviously when the markets come down in the long term, it could be a great opportunity to buy on sale. So if you have some reserves, maybe it's a great opportunity to do that. Like, when the markets are down is the time to find the cash in the cushion, so to speak. Because whether it's, a year from now or 4 years from now, very, very likely we will see prices higher down the road, right? So it can create some great buying opportunities if done properly. And again, if we can take emotions out of that process as well, hopefully you're slowly chipping in as opposed to trying to time it entirely, right? And most of all, fourth piece is just to have a plan in place, right? Be prepared for these, because again, although here we are, 2 and some change years after the last downturn, it will not be the last. We've seen a couple here in 2 years, but typically we see these market cycles, at least every decade. And so we will see another. And so having a plan in place for how to get there is extremely important. What you do as we see these cycles occur, but also to remember the long term. Like, let's put those blinders on for a minute and remember where we're really going. Because although downturns hurt and they're not fun, and we all want the markets just to continue to go up, they will happen again and again and again. And so having a long-term plan in place, even with some of these short-term things that you can do to weather the storm, is the first and foremost, like the key piece of all this. So hopefully that helps. We look forward to seeing you next Thursday at 3. And again, if you're kind of curious about strategies during this market downturn, definitely take a look at last week's session where we talked about tax loss harvesting as well. We'll see you next Thursday at 3. Have a great weekend and try to stay dry.